All right, welcome everybody to the Thanksgiving edition of the Roundtable. I know Thanksgiving was a couple of days ago, but welcome to the November meeting of the Roundtable. Again, it's our session to just kind of share some of our best investment ideas at this particular time. And you can see that I did misbehave again. Remember when we first started this back in midsummer, Ken said that he wouldn't participate if we were required or got involved with any type of costumes, but he never said anything about hats. So went ahead and threw a few pilgrim hats on my three compadres, and then since I actually do have a small amount of Sioux Indian blood, we can't have Thanksgiving without some Indian, so I went ahead and threw a little headdress on myself there. Again, here's the agenda for the November meeting. It's the same as always. We'll talk a few minutes about the overview, give you a little bit of a status update with the scoreboard, but then I'll spend a few minutes talking about I have the big picture perspective this month. Again, for point number 3, we do not have an active challenge to the portfolio yet. It's still a very young portfolio, under 20 stocks, but anytime any one of the 4 of us sees a holding that merits or deserves a challenge, we will do so in the future. And there you see the stocks that we'll be covering. Ken Cabula is going to do some Chinese pulled pork with HOGS. That's Long Ping. He came back from the Irish banking situation and wants to double down on Bank of America. Cy Lynch is going to do BioReference Labs, and then I'm actually going to double down on Ken Cabula's original selection of Abbott Labs. And then if we have a little bit of time, as Ken was saying, we'll go ahead and pursue some questions and answers. Again, here's our reminder that this is an educational demonstration. I think everybody here knows this. We saw a lot of familiar names, but again, no investment recommendation is ever intended at these sessions. We talk about real companies in real time, real characteristics, but any companies we're talking about are for illustrative purposes only, and the shorthand is do your own homework. Ken, I'm getting a little bit more noise from you. I'm going to go ahead and mute you for now. All right, just as a quick reminder, we meet monthly. We try to pick stocks of interest to everybody involved. We are willing to entertain non-core selections. We try to keep that 25% of the portfolio or less. And our overall objective is to build a portfolio over the long term that beats the market by 5%. How are we doing so far? Actually, not too bad on the accuracy side. 56% of the selections, as you can see here, have actually outperformed the market since we got started. We really want that number to be in the 60 to 80% range. And then basically what you see here is the dividend and split adjusted prices of all the companies that have been picked so far, along with yesterday's closing price. So what you have is the total return for all the companies versus the market returns since the time of selection. And again, we're gauging the relative return of every one of the selections. We want this number here to add up. Here's a look at the actual Roundtable dashboard as of yesterday. This represents the selections made since July. Only one of the selections has been repeated. So this represents $2,000 invested into Strayer Education. That's actually been a selection made by me over the last couple of months. The whole portfolio here is, the dashboard is ranked and sorted by descending projected return. So the higher potential opportunities towards the top, the lower opportunities are towards the bottom. But again, we take a look at this portfolio and very quickly decide that our 3 main characteristics, the projected return, the quality, and the overall growth rate of the portfolio, are all pretty much in the range that we want to be in. So good stuff so far. And I'd actually like to take that very topic and talk about that. We talk a lot at Manifest Investing about portfolio-centered decision-making. We basically have the theory that if we learn how to listen to our portfolios, many of the decisions, including those nagging when to sell decisions, can actually get easier. This is the way we boil the picture down. We're here for the returns. We really are. We're here for the returns. We want to identify high potential opportunities in our investing, pursue them, hold them for as long as it makes sense to do so, but that's what we're here for. And when it comes down to portfolio design, here's the situation. We're out there trying to discover high quality, good opportunities and buy when the return forecasts are right. Hold them for as long as it makes sense to do so means that we would be willing to sell them when it makes sense for the portfolio or if the particular company faces some challenges. So again, notice that growth is not a part of that recipe. We do like to find higher growth companies, but it's not a prime consideration. The second point, we're going to cover this here in a couple minutes. Mix it up. Make sure that you have some small, medium, and large companies, and maintain that overall average sales forecast for the total portfolio. What I'd like to do is, again, come back to we're in it for the returns, and sometimes we've experienced this with a number of our audiences. It's a little bit hard to think in terms of returns. We're always thinking in terms of prices. And what I've tried to put together here for you is a look at about a 6-year perspective on the Value Line Arithmetic Index. That's this yellow shaded area. It's basically a stock market index, which includes roughly the 1,700 companies in the Value Line Index. So you can see that it's kind of fluctuated around. And then the red bar charts represent the average Value Line low total return forecast. So basically looking across between the 1,600 and 1,700 companies covered in their standard edition, you can see that this number has fluctuated quite a bit. So again, here's the situation. The stock market from 2004 through Halloween 2007 had been on a fairly steady uptrend, and during that time frame, the forecasted returns were basically pretty flat through this entire period. And then our friend the bear market arrived again around Halloween 2007. The bear market began to kick in, and again, when prices go down, our projected returns go up, assuming the fundamentals stay somewhat intact. So you can see that all throughout this bear market, where the stock price, basically headed south, the projected returns went from, relatively low values of, somewhere around 5%. And they actually peaked out in the depths of that bear market at about 20%. So again, putting this in context, over the long term, though, that fluctuates around from low single digits up to that 20%. We have seen a few occasions where it got up as high as 25. Then the bull market returns, and you see that here. The bull market returns, stock prices actually headed north again. And again, that drives increasing stock prices, drives the projected returns. Again, think Section 5 on your stock selection guides. That drives them down. So again, I'm moving in opposite directions. And again, the stock market has kind of plateaued out again a little bit here in recent history. So again, just keep the returns and the prices in perspective. Here's another look at that same type of information. And what I'd like to do is share some of the stuff that we use in our dashboard diagnostic sessions, where we take real investment club portfolios. We're going to take a look at our portfolio using the same technique. Again, giving it some context. Over the long term, that long-term forecast, and again, just kind of, you can look at either indicator, but let's talk the Value Line forecast for tonight. Right now, the average low return forecast, again, from the 16 or 1,700 companies in the Value Line Standard Edition, is right around 9%. Very close. Very, very close. It agrees pretty favorably with the median projected return at Manifest. So again, you've got that long period here, that the bear market area that's set in. And right now, what we're watching and monitoring fairly carefully is any advance in the stock market's actually going to drive our projected returns farther down. We want to watch that. How do we use that? Well, we're here for the returns. We want to be 5% ahead of this. So our target range for projected returns is roughly 5 to 10% above the market returns. So again, 13 to 18% becomes our target range. For the roundtable portfolio, we actually check in at about 15%, so we're well within the boundaries, within the target range that we set. The other things that we would really like to pay attention to, Ken Kabula refers to this as his portfolio report card. It's a summary of the dashboard. Again, you see the 15%, that's shown up here. But we also want to keep our overall quality rating of the total portfolio somewhere in the 75 plus or minus range. You can see here we've got the target range depicted here. And again, at 75.9, pretty good shape. That's generally a portfolio that's going to weather the challenge of corrections and bear markets pretty well. And then the third primary characteristic that we look for in any portfolio when we're talking about the design of the portfolio is, Nicholson taught us, you want to be between 10 to 12. I think the 11% plus or minus, and at 10%, that's shown right here. We're in pretty good shape. So again, for the roundtable portfolio, even though it's fairly young and we don't want to obsess over any one characteristic at this point, we are seeing a fairly strong formation that's taking shape in just the manner that we would hope it would. So again, we focus in on, for any portfolio, the returns. We want to be in these target ranges. 15% is actually pretty sweet. For a market that's somewhere in the 8 to 9% range, we've got a nice margin there. Fairly decent selections, decent quality, and also sufficient growth. Let's talk a little bit about the growth, because this is something that we emphasize and focus in on at Manifest. We've been taught over the decades to invest in small, medium, and large companies. Note I didn't say cap, I said small, medium, and large companies. We don't look at market capitalization for this. What you basically see here is living proof that the gurus who've told us to do this for decades are right. If you think about the S&P 500, that's basically a collection of very large companies, and we see how that behaved and misbehaved back during the bear market at the early part of the last decade. The S&P 500 is all large companies. The value line arithmetic average has small, medium, and large. It's an all of the above situation. So again, this value line arithmetic average includes small, medium, and large companies, just as it says down here. And what this graph should leap off the page and say to you is, this is why we do this. This is why we have small, medium, and large, because not only is the line straighter, it's actually very well behaved over this 20-plus year period, with superior returns to just investing exclusively in the larger companies. So again, that's what investing in small, medium, and large does for us. It helps us out with these type of bear markets that we see here, where the S&P 500 got crushed. Well, you notice that this one ends in 2005. The next question may be, what have you done for me lately? So again, taking a look at just over the past 6 years, did it hold true again? And again, what you see here is the advent of that bear market, and that it's kind of close. It's kind of neck and neck, but the small companies actually did fall further to get down to this point than the S&P 500 did. So they actually tumbled just a tiny bit further. But Peter Lynch was famous for saying, this is why you want to have small companies in your portfolio. This mix includes small, medium, and large, and notice how well these companies did coming out of the Great Recession. So again, we get that kicker of some of the bigger companies will protect us, but again, in this case, the small and medium companies actually outperformed fairly significantly. So this is a part of our diversification strategy for all portfolios that we take a look at. And let me close with just, again, we don't ignore, we just don't emphasize sector diversification quite as much. Again, our portfolio here at the Roundtable is fairly young, so we wouldn't want to obsess too much. But we can see that since July, we've spread it out pretty well. We have hit 5 main sectors. These are among the most popular sectors, from our community of investors. But we do have a fairly substantial investment in healthcare and discretionary. That could be at least, whispering in the background to discourage us from getting too carried away in those areas. But again, with a fairly young portfolio, you would not want to obsess over this, and you certainly don't have to do any matching or matching up against the 10 different S&P sectors. Well, with that, let's go ahead and take our first break, or semi-break. And in fact, Ken, if you're out there,
I'm here, Mark.
I'll let you go ahead and promote our event.